Okay, so now it is 7 o'clock, so let's get going. Thanks very much, everyone, for attending this webinar. This is the third in our series of webinars on investments. So the first webinar, which was in the third quarter of last year, started in the third quarter of last year, was COVID-19, how should investors respond? And what was discussed in that webinar was that investors should stay invested, because if the economy turns down because of the circumstances of COVID-19, then there'll be a wall of money which will push the stock market back up. And so then the second webinar, which was started at the beginning of last year and then ran through the first quarter of this year, was about the property outlook and how the Reserve Bank of Australia had lit a fire under the property market in Australia by lowering interest rates, creating the term funding facility, why fixed interest rates, 3-year fixed term rates were so low, why we should expect interest rates to rise rapidly over the next 12 to 18 months at that time, but not necessarily so rapidly in the long term. Now, this third webinar in the series is about inflation, as I promised in those first two webinars, that we would start talking about inflation in this webinar series. And we'll come in the fourth webinar to talk about the effect of inflation on the property market and especially on negative gearing strategies, excuse me. But in this third webinar, we're going to talk about the stock market and especially the US stock market and the effect that inflation is having on the US stock market. Now, let me jump into that, and then we are going to talk about a few things about how we're going to run the webinar here. But first of all, let me jump into what this webinar is about. So this slide will explain. So this is about inflation scenarios for investors in US equities. So we've had a massive volume of quantitative easing. I'll show you some slides on quantitative easing a little bit later in the webinar, but the amount of quantitative easing that took place in March and April, from March through May of last year, in just a space of 6 to 8 weeks, was basically as much as took place between 2009 and 2015. An absolute wall of money came out of the central banks around the world, especially out of the Fed, but increasingly large amount coming out of our own central bank, the Reserve Bank of Australia. But absolute wall of money came out of new money, came out of the Federal Reserve in the US. And that drove US stock prices up to the historically high levels that they are today, 50% higher than they were before the COVID-19 crisis started. You would think that COVID-19 was the best thing for the global economy that ever occurred. Such is the level of the stock market. Now we'll look at the evidence that the stock market has gone too high, but going forward here, what we expect to happen over the next 12 months as we come out of COVID-19 is that inflation will rise. Inflation, which has been falling for so long, inflation will rise. There'll be a spike in inflation, in consumer price inflation in the United States and elsewhere, probably quite a big one in Australia, but a large one in the US over the next 12 months. That inflation will go outside of the Fed's range for inflation. The Fed wants to keep inflation between 2 and 3%, but what we expect is it'll go beyond 3% for a short period of time over the next 12 months or so. Now, when I say we, I really mean everyone. The Fed thinks that'll happen. The bond markets think that will happen. I don't really know anyone who doesn't think that that will happen for a whole variety of reasons. Because of the release of pent-up demand, because of problems on the supply side rather than the demand side with supply chains, because there's so much money ready to be spent and held in the checking accounts of US households because of the massive amount of stimulus that we've had and more yet to come. Now, there isn't really much disagreement on that but there's disagreement on what happens after that. After the spike in inflation, what happens next? This is really the $64 trillion question. And over the following 18 to 24 months. And the question is, does the inflation continue upwards? Because if inflation does continue upwards, and inflation goes outside of the Fed's bound of 2 to 3% that the Fed is targeting and stays there, then the Fed is eventually going to be forced to unwind quantitative easing. Over the next 12 months and beyond, the Fed will continue quantitative easing and keep interest rates low at close to zero. It's said that it's going to do that. And our central bank, the governor of our central bank, Philip Lowe, has said the same thing. But if inflation goes higher, the Fed will be forced to taper and then to end, and ultimately to unwind quantitative easing. Now that will absolutely smash the US stock market. And a big part of this webinar is to explain why that's true, to lay out a framework for you to understand why it is that quantitative easing has pushed asset prices up so much. We talked about that a lot in the first webinar, so I'm not going to revisit that in great depth, just revise it quickly. But to understand it at a deeper level, why it is that if the genie goes back into the bottle, if quantitative easing is unwound, tapered, meaning an announcement that it's going to be slowly ended, slowly brought to an end, the creation of new money, and then ended, and then unwound, if that takes place, then I want to show you a framework that explains why the market will get absolutely smashed. Now, it's not obvious that inflation will go up. It's quite possible that inflation will go down after the initial spike. That's what the Fed thinks will happen. That's what the bond markets think will happen. So there's a very strong tension here. And the tension is between history. That's what's going on up here. You know, if you create more and more money, the number of examples throughout history where more and more money is created and it doesn't create inflation is very, very limited. In fact, I can only think of one, and it's an important one because it's Japan over the last 25 years. But there's 500 other examples where more and more new money is created by the central authority, and it creates inflation and very often hyperinflation. And so up here you have history, and down here you have the very powerful forces of global deflation, of demographics, of changes in technology, of globalization, which have been driving prices down for decades, for 40 years. So the question is, does the creation of more and more new money light up inflation? That's what history would tell us. Or do the very powerful forces of deflation that we had before the global financial crisis, before the COVID-19 crisis, return and drive inflation back down? Because if we go this route, the market will get smashed. And I'm going to show you that. And if we go to this route, then the market will go up. It can't go up forever. You know, no tree can grow to the sky, as they say. It'll level out at some point. It'll rise and then it'll level out. Now, what I'm suggesting to you in the title, where it says that investors should think about scaling back their exposure to US stocks, it's temporarily, when I say temporarily, I mean over the next 12 months or so, scaling back their exposure to US stocks until they get past this point of uncertainty. Now, obviously, I'm not telling you what to do here. I'm not in the business of providing financial advice. I'm an educator, of course, an academic and consultant and public intellectual, give myself that lofty title. So I'm not in the business of providing financial advice. I'm in the business of explaining how things work. But nonetheless, in these webinars, I do tell you what my thinking is about what's going to happen and how investors should think about this. Ordinarily, I'm in the business of recommending to people that they do the opposite, or telling people that history tells us and economic theory tells us to stay engaged, to stay invested. And the thinking that you know when to get out of the market and when to get back into the US market, thinking that you can time the market is foolish. You can't do that. I can't do that. You can't do that. It's really the rarest thing. That's called beta, the ability to time, to get out of the market just before it falls and to get into the market just before it goes up. I don't have that ability. You don't have that ability. A few hedge fund managers have that ability, but it really is the rarest thing. And really, when you try to do that, to time your position in the market, you just end up spending a lot of time outside the market. And over a very long investment journey, that's extremely unhelpful, to spend a long time out of the market and in cash. You just end up with lower returns over time. So really what I'm saying here goes against what I ordinarily say. And I'm only saying it for this reason. I'm only saying it because there's such a large piece of uncertainty to be resolved in such a short period of time. And you know, for my own personal circumstances, just to tell you that I'm committed to this and to talk about an example rather than to give financial advice. For Tracy and me, we're not completely out of the US market, but we are much scaled back from our usual large investment in US stocks. Okay, so that's what the webinar is really about. It's about understanding the evidence that US stocks are at historically high levels, and levels that are really too high to be justified by the fundamentals, have been driven up by quantitative easing. That we're going to have a big spike of inflation over the next 12 months, and nobody really disagrees about that. But there's disagreement and great uncertainty about what happens next. And so we want to look at this. What's the evidence that the market's at levels that can't be sustained by fundamentals? We want to look at this, why it is that the market will go down so much if the Fed starts to taper and unwind quantitative easing because inflation has lit up. And then we want to talk a little bit about the evidence that we'll have inflation here, or that will go on this route versus on that route. Okay, let me just say a couple of things before we keep going here. So we'll go about 40 minutes and then we'll just take a break for a couple of minutes. I just know from long experience that if we go for more than an hour without a break in a Zoom session, it's too much. I'll answer your questions when we get to the end. So write your questions in the Q&A. Many of you will have been to the first two webinars and you know how that works. About myself, so I am an academic. I don't work on research nearly as much as I used to, hardly at all anymore. And that's why I say I'm more of a public intellectual, giving lots of lectures and webinars, teaching lots of courses, writing lots of stuff. And so I've been at the Melbourne Business School, where I'm a principal fellow in the finance group since 2004, 17 years now. I'll be back at Melbourne Business School in 2 weeks' time for the first time in over a year. Before that, I was at Dartmouth University in the States, which is Ivy League University in America, in the finance group there. Before that, I was a PhD student at the London Business School, which is the graduate business school of the University of London. And now I work, as I said, I work a lot with industry, do quite a lot of consulting, teach quite a lot, run Windlestone Education. Okay, first thing, what's the evidence that the US stock market is at levels that can't be justified by the fundamentals of how much cash it's going to generate and the riskiness of stocks? Well, let's look at some evidence of that. So we're going to look at the evidence for and against the US market being overvalued at the moment. So here we have the S&P 500 index, and for the most part, I'm going to use the S&P 500 index, which is approximately the 500 largest public stocks in the US, the 500 largest stocks on the NASDAQ exchange, that's the tech stock market, and the New York Stock Exchange, that's the old company stock market in the US. The S&P 500 is an index of approximately the 500 largest companies, not exactly. So I'm going to talk about that as the market for the most part, and we can see how much the S&P 500 has zoomed up over the last 40 years. In aggregate, those 40 years have been the greatest bull market in history, as everyone knows. Now we're just zooming in a little bit and looking at what's happened in the COVID-19 crisis. Of course, the COVID-19 crisis smashed stock prices, but then a wall of money drove stock prices back up and to 50% higher than they were. Well, actually not quite 50%. Here the market was at approximately 3,000 and it actually peaked at about 3,347, I think, before the COVID-19 crisis. But it's certainly driven it up a great deal since the bottom of the crisis for the stock market in March of last year, and that's because of the wall of money that came out of the Fed, and it's driven it right up to here, up to 4,140 today. Now, so just showing these graphs doesn't prove that the market it's gone up a lot, doesn't prove that it's overvalued. We need to compare that to something. So the first thing to compare it to is GDP. So we can see here the value of the total capital, the value of US stocks, including the stocks that are not in the S&P 500 in this graph, the value of US stocks relative to GDP. So in the bear market in the 70s, that went down below 50%. And now, this graph only goes to the end of 2020, and the market has risen 10% since then. So now it's about 245% of GDP, which is so much more than it's ever been in the past. Now, people who don't think that the stock market is overvalued will say that the reason that it's zoomed up here is because profits are a bigger part of GDP. So wages as a share of GDP have gone down and profits have gone way up. And also that America has just become the tech center of the world. If you want to invest in tech, in the big platforms, in the tech that is transforming the global economy everywhere, then America is the center of that. How else do you get large-scale exposure to tech other than to invest in the American stock market? Excuse me. How do you achieve that? So people will say that something has really transformed. The proportion of GDP that is the profits of companies, and also that just the drive in tech in the United States, in the platforms and in those huge tech companies. But I'm not convinced by that. I think that this is the effect of quantitative easing, and I'm going to show you strong evidence of that as we go along. This is the value of the market going above what fundamentals can justify. Now let's look at some other things. So this is comparing the market to historical, the ratio of the value of the market to GDP historically. You can see that it's just gone stratospheric. And then let's look at some other things. So another thing would be to compare prices to earnings. And here we can see that the price to earnings ratio, this is the cyclically adjusted price to earnings ratio, Shiller's cyclically adjusted price to earnings ratio. We can see that it's the only time it's been anywhere near as high as it is at the moment is in the dot-com bubble, immediately before the bursting of the dot-com bubble. Even in Black Tuesday, back in the Great Depression, in October of 1929, it wasn't nearly as high as it is now. Now, the price to earnings ratio is always a measure of value. The PE ratio is the price of a share. Here we're talking about the whole market, but the price of a share divided by its profits over the last year. Sometimes it's forward-looking, in which case it's the price divided by the anticipated profits over the next year. But in general, it's price divided by the profits over the last year. So it's the number of dollars investors are prepared to pay for the share per dollar of today's earnings. That makes it a measure of value. And if people are expecting more growth, or if there's less risk, the things that they like, more growth or less risk, then they'll pay more per dollar of today's earnings. So it'll have a higher PE ratio. So, and when PE ratios get very high, that's an indication that valuations are going too high. Now, Shiller's measure averages out, because earnings are very volatile, it averages out earnings over the last 10 years. And so we have price divided by inflation adjusted earnings over the last 10 years. And this is really a very strong and useful measure of valuation. And you can see how high it is at the moment. Strongly indicative that stock prices have gone beyond what can be justified by fundamentals. Now, it's still the case that earnings per share is using an accounting measure. And here we're talking about finance things rather than accounting. So earnings, net income or profits, that's an accounting thing, which can sometimes be a lack meaning, and it can also be manipulated. What about just the cash that is coming out of the market? What about comparing the value of the market to how much cash is coming out of the market? That's a much more finance thing for us to do. Let's do that down here. So if we would look at dividend yield, and dividend yield is here, of course, are the dividends divided by the price. And so, you know, a company that has a share price of $50 that pays a dividend of $2 over the year has a dividend yield of 4%, the $2 of dividends divided by the $50 of the price. And we can see how much dividend yields have declined over time in the United States. And that's not because less cash is coming out of companies. It's just because there's a lot of buyback of shares. After the early 1980s, companies increasingly in the United States paid cash out to shareholders, and they still do to this day, paid cash out to shareholders by buying back shares. And they do that because if you buy back shares, you put the earned cash of the company in the hands of shareholders in a way where they have to pay capital gains tax on the sale of the shares back to the company, as opposed to income tax if it's a dividend. So buying back of shares puts the cash created by the earnings of the company, the profitable operations of the company, in the hands of shareholders where they have to pay capital gains tax instead of income tax, which is in the United States, income tax is a lot higher than capital gains tax. That's true in Australia, of course, as well, with the capital gains, 50% capital gains discount for shares that are held more than than 5 months. So what we really need to look at is both dividends plus the buyback of shares. And that's what we have here. Don't have quite as much data in this slide as we had here. We got annual data instead of quarterly data, which is why it's all curvy. But we have dividends plus share buybacks, and we're subtracting out capital or cash that's going back into the company or back into the S&P 500 companies. So we're looking at all of the 500 companies in S&P. Many of them are paying dividends. Many of them are buying back shares to get cash out. Quite a lot are selling new shares to raise capital. And of course, that's cash going in instead of coming out. And so to see how much cash is coming out of the market in total, you have to subtract that out. And then we're dividing by the market capitalization of the S&P 500 to get a measure of the cash yield of the S&P 500. How much cash is coming out of those companies into the hands of shareholders relative to the value of the market. Now we can see that that has just fallen off a cliff in COVID-19. And it's not just COVID-19, that was occurring to a certain extent before COVID-19, but it really is about the quantitative easing associated with COVID-19. We're down now to levels, this has actually fallen a bit lower than it was before. It is expected to recover because dividends and share buybacks will go up after the low profits of 2020. But we're heading down towards values that followed the global financial crisis that surrounded the bursting of the dot-com bubble. So this is an even better measure of whether the market is overvalued. We look at the ratio of the market value to GDP and seen how high that is historically. We looked at the CAPE ratio, Shiller's cyclically adjusted price to earnings ratio. It's called cyclically adjusted because it averages over 10 years, which means over at least one business cycle, and how high that is. And then just how little cash is coming out relative to the value of the market, or how high the value of the market is and how much that's driven down the yields on the market. Now here we can see, here we're repeating the graph that we had a minute ago of GDP, of the total value of the US market versus US GDP. And what we can see is how much this is zoomed up during periods of quantitative easing. So this is 2009, March of 2009, when the market hits its nada, hits its lowest point. And then quantitative easing goes on until early 2015, late 2014, early 2015 in 3 different rounds. And then this is the market collapsing in COVID-19 and an absolute wall of money coming out of the Fed that goes on to this day. And look, I mean, honestly, how hard is it to see what's going on here in terms of the market relative to GDP during periods of quantitative easing versus other periods since quantitative easing started after the GFC. Looking at graphs is not really a substitute for economic theory, and we're coming to economic theory in just a moment, but those graphs are very compelling about what it is that's driven the market up to these record levels. And so, you know, that's what makes me feel comfortable about pulling back from the market until this period of uncertainty is past, is that, you know, if you pull away from the market, and I'm always very reluctant to do that because I don't think I can time the market. These are really quite special circumstances. If you pull away from the market, then you know what you have to trade off is the danger that you'll miss out on the market going up relative to the benefits of missing out on the market going down a lot under these special circumstances. But there's something very big to be resolved, a lot of real uncertainty to be resolved in the next 12 to 18 months. And that's the thing that I'm really focused on. Okay, so what we've been looking at is whether the market is overvalued. It is, in my opinion. Not everyone agrees with that. Some people believe, you know, obviously many people, because you know, it's quite natural to ask, if the market's overvalued, why hasn't it fallen already? You know, why doesn't everyone pull some or all of their money out of the market? And why don't people who are not in the market actually short sell the market? Well, short selling's become quite a dangerous thing. You know, we saw in the GameStop episodes how beat up people can get if they take short positions in the market. Short selling is a more dangerous thing than it used to be. It's also true that most of the money in the stock market most of the money, and here we're going to this question, why hasn't the market fallen already? You know, there's obviously so many people who think the market's not overvalued because they've still got their money in it and they've got no intention of pulling it out. But, you know, one thing that we should recognize here is that most of the money in the stock market in Australia, in the US, is in the hands of institutional investors, in big super funds, pension funds in the United States, insurance companies, mutual funds, hedge funds, etc. So probably we shouldn't put hedge funds as institutional investors, but certainly super funds, managed funds, mutual funds, pension funds, you know, those are the same names, super funds and pension funds, managed funds and mutual funds being the same things in the US and Australia respectively. But in any case, those institutional investors, they are relative valuation investors. What they really care about is how well they do relative to their peers. What you and I care about in managing our money as private investors is how much wealth we have. What they care about is not so much how much wealth their clients have, the people they're managing money for. What they care about is how much new wealth they will attract and the fees that they'll earn by managing more money. And what you need to manage more money is to outperform your peers. You know, PIMCO doesn't need to get high returns. What it needs to do is to beat Fidelity and to beat BlackRock. It needs to beat its competitors to attract the money in the market to earn the big fees for managing the money. So they're relative performance investors, whereas you and I are total performance investors. We care about the level of wealth, whereas they care about their relative performance relative to the index or relative to their peer group, and whether they're in the top quartile of portfolio managers over the last year. Now, it's very dangerous to get out of the market. You know, it can simultaneously be dangerous to stay in the market if you're a total return investor like you and I, and at the same time could be dangerous to get out of the market if you're a relative performance investor. You see, if you're a portfolio manager at BlackRock, I don't mean to pick on BlackRock, I mean, they're a terrific organization, but if you're a portfolio manager at BlackRock, the dangerous thing to do is to deviate from your peer group. If you stay in the market and the market goes down, you just did what everyone else did. If you leave the market and the market goes up, then you really have put yourself at risk of being fired. And so, you know, a significant part of the answer to why haven't people sold out of the market, it's because the safe thing to do is to stay doing what your peer group does. Now let's look at some other things here. So the question, and here we're looking at arguments against the market being overvalued. So people will argue that interest rates are now permanently lower, or over a long period of time, interest rates have been coming down, 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 and as the required return of investors goes down, then the price of shares goes up, and the price of all risky assets goes up as required return goes down. Now that's true, but let's not forget that most of what's driving the 10-year government yields down in the US and in Australia and around the world is that inflation levels are going down. And reductions in inflation, or even increases in inflation per se, just inflation by itself, as I'm going to show you in just a moment, isn't actually going to affect the stock market that much. Because when inflation comes along, yes, it affects the required return. Investors need a higher return, but it also affects cash flows. So required return goes up, cash flows go up, and that's a wash for the most part. The growth in cash flows goes up with inflation. These are all nominal rather than real things that we're talking about here. You know, nominal meaning without inflation taking out. So yes, the required return goes up to compensate for inflation, but also the growth rate of cash flows coming out of the market goes up with inflation, and that's a wash, those two things. And it's the same when inflation is coming down. Required return comes down, which drives share prices up, but then the growth rate of cash flows goes down. And that, for the most part, is a wash. And so, look, I shouldn't say that inflation is not important because it does affect the risk premium that investors demand. And I'll talk about that some more in just a moment. But for our purposes, the significance of inflation is that it affects quantitative easing. You know, quantitative easing has been brought in to fight deflation, to try to generate inflation, to overcome the deflationary forces in the global economy. You know, we're heading into quantitative easing even before COVID-19 came along, as I emphasized at great length in our first webinar. So it's not inflation per se that affects the stock market. It's that inflation is creating quantitative easing, and it's quantitative easing that affects the stock market, the creation of new money, and people trying to get rid of that new money, get rid of deposits by buying assets. And I'll revise that concept in just a moment. Now, also, people who think that the market is not overvalued emphasize this, which I talked about a bit earlier. Emphasize that corporate profits as a percentage of GDP have gone up a lot. That's the red line here. You can see that corporate profits, right up until a little after the dot-com bubble, corporate profits had been at about 5% of GDP, and now 5 to 6% of GDP, and now they're at 9 to 10% of GDP. Now, it's not obvious that that's permanent, that they can stay at that very high level as a percentage of GDP. This is a big issue in discussions of equity and the effects that quantitative easing and other things are having on equity. But it's not quantitative easing that's causing corporate profits to go up here. This is mostly being caused by a lack of competition, by changes in technology, but also about concentration of industry in the United States. Industry's become a lot more concentrated in the United States. The number of industries that are dominated by two or three companies in the United States has gone way up. You know, measures of concentration of industries like the Herfindahl Index, which is, as I said, a measure of concentration. How small a number is the number of companies that dominate an industry, that's gone way up in the United States. So most of this is about a lack of competition, or a significant part of it. So it's not obvious that it's permanent, but if it is permanent, you know, then that's a good point. That is a reason why that is a strong point in discussing why it might be that the market's not overvalued. And of course, people talk about these other things as well, that investors don't need as high a return because the risk premium that they're demanding for being in shares has gone down. The world's a less risky place, you know, and if you think the world's not a less risky place, then you're not thinking about the world that your grandparents lived in, or if you're as old as me, the world that your parents lived in. You know, my parents lived in a world where they were born in the Great Depression. They grew up in the Second World War. They lived through the Cold War. You know, they were the children of people who went to the First World War. They were born in the Depression, lived through the Second World War and through the Cold War. I mean, I know that things sound bad at the moment, but they're not like that. Like, they're not like the two world wars and the global depression. And, you know, those things give people a great degree of risk aversion. And so, you know, usually when people are saying that the required market risk premium, the required extra return for investing in the stock market instead of putting your money into risk-free assets like bonds or into the bank, that extra return that people need has gone down. And it's because they've just had a different, you know, there's a generation or two generations that have had a different experience, and to some extent have forgotten about how risky the world can be. All right, let's push on. I talked about tech dominance, and there's a lot of people who believe that there's not going to be any unwinding of quantitative easing. This is really a statement that deflationary forces come back. All right, let's push on a bit. There's actually something else I wanted to say, and it's this. I wanted to just tell you about this is an advertisement, by the way. I wanted to tell you about my Finance Education for Investors course. This is the Windlestone course, the Windlestone Education course. And so it's an 8-week course, which starts on May the 6th and runs for 8 weeks through May and through June. It runs from 7 p.m. to 9:30 p.m. It's in Zoom classes. This is a webinar, and so I can't see you, but these are Zoom classes where we can see each other. They're not very large classes. They're limited to 45 people. They discuss the classes and all of the other contents, including a very large number of videos, plus a lot of notes, and one-on-one discussions with me. All of that has the purpose of giving you the feeling and actuality of empowerment in your investing and getting you onto an investment process that'll carry you to your goals. So really the center of the course is understanding what is a good investment process and getting you onto that investment process. This is education and not financial advice. What's integrated into discussing the investment process is all the knowledge that you need about investing, how to create an investment strategy that suits you, what's a good investment philosophy, a good set of guiding principles. Anyway, many of you who are watching have taken the course, so I think you'll agree that people love the course. And so I urge you to come to the free information session, which is on the 22nd of April, so it's coming up. And then I can explain to you what it's all about. But go to Windlestone to enroll directly in the course. You don't need to come to the information session. You can just come straight to the course or to register to come to the information session. So now what I want to do is just get started on talking about a valuation model. So I just want to lay out a simple model of valuation of shares to show you how sensitive it is to quantitative easing, how sensitive it is to yield compression, how quantitative easing compresses the required returns of investors, and how that drives up share prices. Now, in the first webinar, I showed you this using a diagram, which I'm going to show that diagram again in just a moment, but I didn't sort of show a simple framework for putting the numbers together here. And that's what I want to do here. And the reverse, of course, of yield compression is yield decompression. If quantitative easing comes to an end, yields will decompress and stock prices will go down. And they won't go down a few percent. They'll go down 30 or 40%, and they'll stay down permanently. And that's what I want to bring out here, how sensitive stock prices are to yield decompression and what yield decompression actually means. So these are definitions that appear here. I'm going to take a break in just a moment. These are definitions that appear here. That's for your future reference. You should have the slides, by the way. If you don't have the slides, something went wrong because I emailed the slides today to everyone who was registered to come to the course. But if you don't have the slides, then just send us an email and we'll send them to you. I won't send them to you right now because I'm giving the webinar, but Tracy will send them to you tomorrow. Okay, what we want to talk about here is thinking about the future cash flows and how the future cash flows add up to the price that people are prepared to pay for the stock. So what drives the value of any asset? For most of you, this will be a very familiar idea. What drives the price of any asset is two things. It's the quantity of cash flows the asset will deliver and the quality of those cash flows. The lower quality they are, the riskier they are, the harder it is to buy or sell the asset, the longer term the cash flows are, the lower the quality, the lower the price. The higher the volume, the higher the price. And in valuation of assets, and by assets here I mean shares and property and bonds and infrastructure and private equity and the like, the valuation of assets is a combination of estimating these future cash flows and then working out the required return of investors and combining those two things. These future cash flows, estimate of the future cash flows, and then the required return. Now, let's just use that here. Let me just set this up for 1 second. And let's just use that here to think about the valuation of the whole of the S&P 500. So I'm going to treat the whole of the S&P 500 as if it's a single share. So it would be a share worth $34 trillion. That'd be a hell of a share. And it'd be a share that threw off $900 billion of cash every year. In this slide, we were looking at how much cash is thrown off. These are annual figures. These are showing the quarterly. These are the annualized quarterly figures for buybacks of shares and for dividends. And you can see that most cash coming out of the S&P 500 is by companies buying back their shares. But they also pay dividends, not as large as in Australia. They don't have franking, dividend imputation, franking credits in the United States. So they don't have that impetus to pay dividends to attach corporate tax credits, franking credits, dividend imputation credits too. But you can see, if we go back to 2018, 2019, about 1.2 trillion is coming out of the S&P 500 into the hands of shareholders of all those companies as dividends, 500 billion of dividends and 700 billion of share buybacks. Now, the reason I write 900 billion here instead of 1.2 trillion as what we expect to come out next year in the following year is because there's an amount of raising of capital as well. There's money going back into those companies. There's companies who are selling shares as well as companies who are buying back shares. So what we're interested in, if we're going to think about the S&P 500 as a single share, is how much cash comes out of the market, the net amount of cash that comes out of the market. And there's about 300 billion that is going back into the market in the form of the issuance of new shares. So what we have is in thinking about the S&P 500 as a single share here is a share worth 34 trillion that's throwing off about 900 billion, 0.9 trillion per year, and where that's expected to grow fairly rapidly, at least at the rate of inflation plus the growth rate of the economy. Now, when we come back, I just want to take that very simple, those simple ideas and look at what's happened with the compression of required returns. What are the components of the required return of investors? And why have they gone down because of quantitative easing? And why has that had a massive effect on share prices? So when we come back, I just want to talk through that simple idea to show you how sensitive the value of the S&P 500 is to the compression of the required return of investors. I really want to give you a framework in which you can see how much the compression of yields has driven up the S&P 500 and how much the decompression of yields, if inflation forces the Fed to taper, unwind, end quantitative easing, how much that will decompress yields and how much it'll drive down the stock market, why it'll drive the stock market in the US down 35 or 40%. So this simple framework for thinking about the value of the US stock market. We're going to think about the whole of the S&P 500. Not all of the shares in the US stock market are in the S&P 500, by the way. The total value of public shares in the US is about 49 trillion. The total value of shares in the is about 49 trillion, and the value of the S&P 500 is 34 trillion. So there's quite a lot of valuable shares that are not in the S&P 500. But in any case, we're thinking about the S&P 500. Most of you, if you invest in the S&P 500, or many of you will be doing that through exchange-traded funds that are tracking the S&P 500. Anyway, let's think about the S&P 500 as a US market. Let's think about it as a single stock. And we're thinking about its value in terms of how much cash it's going to throw off and what the required return is, the quality of those cash flows, the quantity and the quality of those cash flows. And this is just a simple model in which we assume the cash flows grow at a constant rate into the future. Now, a lot comes out of this simple model, as you'll see in just a second. Many of you will be familiar with this, some of you won't. And it doesn't hurt to revise it in any case. And what we're thinking here is that investors they're looking at these cash flows. So we've got $900 billion in the next year, growing at some rate G, and we'll come to what G is in a minute, but we're really thinking of approximately the growth rate of the economy plus inflation, the real growth rate of the economy plus inflation. And over here, R is the required return of investors. And like any investors, the way that we're going to get our return, excuse me, is in terms of a yield. We're going to get a yield from the cash coming out of the asset, and that'll be C divided by P. The 900 billion, the 34 trillion, we're going to get a 2.6% yield, and then we're going to get capital gain. So as these cash flows rise, the cash coming out of the market, it's going to drive up the value of shares. As the cash flows coming out rise at G% per year, we should expect the value of the market to go up at G% per year. The volume of the cash flows is going up. Their quality is not changing. If their quantity is increasing and their quality is not changing, then the rate at which their quantity increases, that's what G is, that's the rate at which their valuation will increase. So we're expecting to get this cash yield, and we're expecting the value of the shares to go up by G. And what we can see in the market is this 2.6%. Now, we don't know what G is. People have to estimate how rapidly cash flows are going to grow. And we don't know what their required return is, but we do know from historical evidence approximately what the required return of investors is. But when we combine these things, when we say that the required return is the yield, the cash coming out divided by the price, plus the growth rate in cash flows, then it's easy to rearrange this thing. To say that investors' required returns is the yield plus the growth rate of cash flows, it's easy to rearrange and to get that the value of the market is this multiplier times this year's cash flows. The 34 trillion is this multiplier times the 900 billion. And that multiplier is just 1 over R minus G. Now, at the moment, we can see that this multiplier is, well, we will see in just a moment that this multiplier is approximately 38. The 34 trillion value of the market is 38 times the cash that will come out next year. But that multiplier of the market being 34 trillion, 38 times the cash that will come out next year, is really driven by this difference. The difference between the required return of investors and the growth rate of cash flows. It determines the multiplier, how much the value of the market is worth as a multiple, which is currently 38, of the cash that the market will deliver next year as a combination of both dividends and the buyback of shares, minus the amount of money going back into the market by the issuing of new shares by some companies. But you can see here why we really need to focus on R and G. And also that what this brings out is that relatively small changes in R and G will change this multiplier a lot. You know, if that difference was 10% instead of 2.6%, then instead of our multiplier being 38, it'd only be 10. It'd be 1 over 10% is 10. If that was 4%, let's say our required return was 9% and the growth rate of dividends was 5%, investors need a 9% return and they're expecting growth of 5%, so this is 4%, then 1 over 4% is 25. The multiplier would be 25 instead of 38. In fact, that's a more typical figure, as we'll see in just a second. But what I'm pointing out here is that we should really focus on this difference. And that's what quantitative easing does. It changes this difference and changes the multiplier. And it has a big impact on the multiplier. Small changes here have a big impact on this, and therefore a big impact on the market. Quantitative easing isn't changing the amount of cash that's coming out of companies. It's changing this multiplier, and it's changing it by changing that, compressing it, and making this a smaller number, and the multiplier a bigger number. And if quantitative easing goes away, it'll decompress it, and that thing will go back up. And this will become a bigger number, and that'll make this a much smaller number, much smaller number. That's what I'm going to bring out for you here in this. So let's look at this cash flow model for the S&P 500 without quantitative easing. So what I'm thinking about here is, let's just go back to the world before quantitative easing. Let's go back to the world of 2006, 2005, 2004, 1995, 1985. Let's go back to the world before quantitative easing and see what our model looks like typically. And when I say typically, I'm using historical data here. I'm not laying out what the historical data is, but I'm hoping that you'll accept that I know what the historical data looks like. I'm not just pulling these figures out of thin air. So the required return of investors is approximately this. If we go back to before quantitative easing, investors need compensation for inflation. Now notice I haven't written a number for inflation here, and I'll tell you why in just a second, because it appears over here as well. And it turns out it doesn't matter what the number is, because it's both in R and in G, It doesn't really matter what inflation is. And I was saying that earlier in the webinar. But on top of inflation, investors need a real interest rate of 2%. And this is what we've got. This is really the yield on bonds. You know, investors could put their money into government bonds and they would get inflation plus 2%. Now, that's not true today in the world of quantitative easing, but that was true before quantitative easing. And I'll show you the data for that in just a moment. That the real interest rates, the yields on government bonds, long-term real interest rates were about 2% above the inflation rate. The yields on bonds were about 2% above the expected inflation rate. These are all expected rates. We're looking into the future, not into the past here. And then on top of the yield on government bonds, investors needed a market risk premium of about 5%. 5% extra per year. Now, those of you who have looked at historical data and seen figures of more like 7 or 8%, well, there's a few things going on here. For one thing, this is a geometric mean and not an arithmetic mean. I know that's a very technical thing to say, so let me just walk backwards from that. But those of you who know what market risk premium data looks like, let's just remember this is a geometric mean and not an arithmetic mean. But in any case, let's go with our 5% here. 5% extra return above the yield on government bonds for investing in the stock market, the extra risk of the stock market above government bonds. So they require a return of 7%. They're expecting growth of inflation plus 3%. So you see, inflation is both in the growth of cash flows and in the required return of investors. That's what I mean by inflation being a wash. It appears in R and in G. And it's the difference between R and G, 1 over the difference between R and G, that's giving us our multiplier of the value of the market relative to how much cash the market's going to throw off. So if inflation goes up, it's not inflation per se that is the issue. That will affect both the required return of investors and the growth rate of cash flows. And so it'll just subtract out. The effect of inflation is its effect on the Fed's attitude to quantitative easing. Because quantitative easing will affect R and it won't affect G. And if quantitative easing ends, it'll increase R. It'll decompress those required returns which are being compressed by quantitative easing. So let's have a look here. Let's have a look at what happens when we go to a world of quantitative easing. Well, what happens is this real interest rate gets compressed. You know, where we are at the moment is instead of having 7% here and 3% here, and this being the real required return and this being the real growth rate, 7% and 3%, 4%, a multiplier of 25. Once quantitative easing compresses these real interest rates, we get to a multiple of where we are today, 38 times cash flows, because this thing is being compressed. And now the difference between the growth rate, quantitative easing hasn't affected anything over here, but it's affected the required return of investors. It's really killed this real interest rate. And it's shrunk this difference and it's increased the multiplier. Now, let me show you what that looks like in historical data. So what this graph shows is expected inflation. So it's showing this thing, expected inflation. And where do we get that from? Well, it turns out that in the United States, there's both normal government bonds and then there's inflation-protected government bonds. They're called Treasury inflation-protected securities. They're called TIPS, Treasury inflation-protected securities. They're not normal Treasury securities, not normal bonds, which get affected by inflation. They're ones where there's inflationary protection. And the difference in the yield on normal bonds and the inflation-protected bonds tells you what people think inflation is going to be. And that's what we're looking at here in this data. So this data is from the Federal Reserve Bank of St. Louis, FRED, as it's called, which is a great data source, by the way. Just type in FRED and anything that you're looking for in the United States, literally F-R-E-D, and then a space, and then GDP. And a graph will come up showing you US GDP back to 1947. Just try it. Don't try it right now, but Try it at some stage if you're looking for US data. But in any case, back here, we're looking at expected inflation back to 2003. This is as far back as the Fed data goes, back to 2003. And this is the yield on US Treasury bonds. So the blue line is this, the whole yield on government bonds. And the red line is this, expected inflation. And look at what's happened to it over time. This used to be about 2%. We used to have a real interest rate of about 2%. And if my graph went back further, there's other ways of measuring expected inflation, but if my graph went back further, take my word for it, this 2% holds up going back into history. Now we have quantitative easing after the GFC, and it compresses that yield. It compresses that real interest rate. You see how the rounds of quantitative easing compress that down to zero? In fact, to below zero. And then there's a bit of up and down. And then there is a period where it decompresses. You see how here in 2018, this decompresses, which means this thing is opening up again, that required returns are going back up, and that means the multiplier will go down. Well, let me show you what happened to the market here when this started to decompress, when the Fed was starting to unwind quantitative easing, which was decompressing this difference, the unwinding of quantitative easing in late 2018. Janet Yellen announced the acceleration of the unwinding of quantitative easing, and it caused this to decompress. And here's what happened to the market. That's this. You see, this is the end of 2018, and you see the decompression between Treasury yields and expected inflation. You see what happened to the market? You know, that in spades, that multiplied by, well, actually the market fell 19.9%. So that multiplied by 2 or more is what happens if the Fed unwinds quantitative easing going forward, because inflation takes off in the medium term, not in the short term. In the short term, everyone expects inflation. But you can see that in this burst of quantitative easing, so we've got quantitative easing causing that compression, those real interest rates to go essentially to zero. What used to be 2% going close to zero or to zero, below zero. Well, in this big burst of quantitative easing, even greater quantitative easing in COVID-19, look what happened. This thing's actually gone negative. Now it's starting to unwind a little bit, but this has really driven the market up. That drove the market up. This drove the market up. And it drove it up because of the compression of these real interest rates. And you know, why did that happen? Why did those real interest rates compress? Here I'm showing you the phases of quantitative easing. And what we're looking at in this slide here, I know we've gone over time, by the way, so I'm just going to speed up and then we'll go to questions. So I'm only going to spend a few more minutes on talking about our webinar, and then we'll go to questions. The webinar will be over and we'll go to questions. But you can see this quantitative easing, which we talked about a lot in our first webinar, is the Fed buying bonds. So what this says is these are the assets of the Fed. So the liabilities of the Fed are the new money that's created, that it pumps out there, because all money out in the economy is the liability of the Fed, of the central bank. That's true in every economy. And when they create new money, they buy assets with it. What do they buy? They buy bonds. They buy government bonds. And when they buy bonds, they drive down the yield on bonds. That's what this compression is. That's what this compression is. That's what this compression is. It's the Fed buying bonds and driving up the price of bonds, driving down the yield of bonds towards the inflation rate and even below the inflation rate. That's the negative part of these curves. That's where the blue line goes below the red line, like it's been down here in the first part of 2020, down here. And that compression of R is reducing this and increasing the multiplier in the way that we've said. And if it decompresses, because the Fed unwinds quantitative easing, you know, that's not the buying of bonds, that is allowing bonds to mature. That's not money coming out of the Fed, that's money going back into the Fed as the bonds that they bought mature and are paid off. So in any case, remember that we talked about in the first webinar, we talked about these rounds of quantitative easing, but the Fed's assets how much they grew, how many bonds the Fed bought, how much that compressed bond yields. Of course, and here we're looking at, you remember we were looking just a moment ago at the unwinding of quantitative easing and the effect that that had on the market. This is the unwinding of quantitative easing, which is causing this decompression of bond yields, which caused the market to tank by 19.9% until the Fed gave up. You know, the Fed tried to start to accelerate the unwinding of quantitative easing to get back to normal. The market revolted and the Fed gave up. You know, the Fed and every central bank, in every good economy, in every developed economy, is the Fed, the central bank's independent from its political masters, but it's independent from politics, but it's not independent from the markets. The Fed can't just do whatever it wants. The markets can cause panic, and the Fed can't ignore that panic, as we saw in that example. Now we use this slide in our first webinar to talk about the fact that the Fed buying bonds by creating new money, and these bonds going into the Fed, buying up bonds, driving up the yield, driving up the price and compressing the yield, and the effect that that then has on the stock market. You know, that the buying of bonds creates deposits in the banking system. And it's what happens to these deposits in the banking system that will determine what happens to inflation. We talked about this a bit in the first webinar, and we'll talk about it more as we go ahead in webinars. But it's what happens to these deposits. If people use the deposits to buy assets, shares, property, bonds, infrastructure, then we get asset price inflation. If people just sit on the deposits, the Fed buys more and more bonds and they sit on the deposits and do nothing, then we become like Japan. That's the Japanification, if such an adverb exists, which it doesn't, but that's the Japanification of the US economy, that the Fed buys more and more bonds and households just sit on the deposits. Now, if households don't sit on the deposits, they buy consumption goods, they buy cars, they buy holidays, they buy education courses, that's a good thing to buy. They buy restaurant meals, they buy sporting equipment. If they spend it on consumption goods, then we get consumer price inflation. So the crucial thing is, going forward, what happens to the new deposits? Now, let me show you what the new deposits look like. And this is the last thing I want to talk about here. This is showing you how much quantitative easing drove the S&P 500 up, both in the global financial crisis and this is just showing the correlation between the expansion of the Fed's balance sheet after the GFC and the expansion of the Fed's balance sheet and the S&P 500 in the COVID-19 crisis. You know, I mean, look, economics is not about showing graphs, but I tell you, that is very, very compelling about the effect of quantitative easing. Anyway, let me just show you this last slide, and then I'm going to wind it up, and then we're going to go to questions. So these are demand deposits. Now, total deposits in the US are about 18 trillion, and they're up by over 5 trillion just in this COVID-19 crisis. But demand deposits are deposits that are not held as term deposits. You know, if there's 18 trillion, 14 trillion are term deposits. That's money that people have locked up. And they've said, you know, I don't want to spend that money yet. I'm going to lock it up for 6 months or 12 months in a term deposit. But demand deposits are money that people expect to use in the near future. And the increase in those demand deposits in the United States is 10% of GDP. Check this out. 1.6 trillion to 3.6 trillion since the beginning of the COVID-19 crisis. That is $2 trillion, which in the US is nearly 10% of GDP, waiting to be spent. That's why people are expecting this burst of inflation. Everyone is expecting a spike in inflation in the next 12 months. But then what happens after that? You know, do we continue with inflation because of more and more quantitative easing and that, you know, eventually the creation of money? So this is the issue about the deposits. If the more and more deposits causes American households to increase consumption spending, then we go this way. If they spend the new deposits, we go this way. If they hold on to them, then, you know, we end up like Japan, where you just have more and more quantitative easing, but it doesn't defeat deflation. But let's forget about that. If they spend the deposits on consumption goods, we go this way. If instead the deflationary forces in the global economy come back, which is right on the cards, we go this way. Now, my point here is I don't know whether we go this way or that way. And I wouldn't pretend to know. History says we go this way. You print a lot of new money, you create a lot of new money, it'll create inflation eventually. The bond market and the Fed think we go this way. And deflationary forces are very powerful. There's no doubt about that. So I don't know whether we go this way or this way. But I do know the market is heavily overvalued at the moment relative to fundamentals. And I've been showing you that in the webinar. And this isn't that long a time to sit out. Now, I can just tell you about my own personal circumstances. We've sold about half of our exposure to US shares. So I'm not out of the market, but my exposure is way down. About, we have exposure to US shares in two different ways. In one of those, I've shut down. And so I'm about 50% less exposed to the US market than I was before. And I don't like being out of the market. And I don't think that I can time the market. But I am happy to sit out until this big piece of uncertainty is resolved. And I don't know which way it goes. And I'm not pretending to know which way it goes. But I am prepared to sit out until that uncertainty is too much for me. Not to sell all of my exposure to US shares, but to sell down 50% of it. Okay, I hope this has really helped you to understand what's going on, help you with the framework. I hope you'll come to more webinars. I hope if you haven't taken our investments course already, let me show you that again. If you haven't taken it, then I hope you will consider that. Go to windlestone.com.au to enroll directly in the course, which starts on May the 6th, or to come to the information session to hear a lot more about the course, hear really everything about what the course is and why it helps people so much. And so we'll keep going with our webinars as time goes on. We'll have one on property in due course, but I'll run this one for a bit and then we'll go to one on property. I really hope this helps you to understand or gives you a framework for thinking about what's going on in the US. All right, let's go to some questions.